What's the difference between investment return and investor return? The investment return is what that particular investment did over a certain time frame. The investor return is what investors who place their money into that investment, what they actually experienced. And oftentimes there is a big difference. And I'm going to reference a couple articles here. The first one is from thebalancedmoney.com. This article is as of November 22nd, 2021, titled Why Average Investors Earn Below Average Market Returns. And in their research, this was actually done by Dalbar, but for the 20-year period ending December 31st of 2019, the S&P 500 index, which many people call the market, the stock market, averaged 6.06% per year. That's not every year, year in and year out. That's the average over 20 years. Whereas the average investor in an equity mutual fund, many of them trying to achieve similar returns to the S&P 500, their average annual return in that 20-year time period was only 4.25%. And you can see what is happening is at the bottom of this section of the article, investor behavior is often illogical and based on emotion. I'm going to take a look at another study. Now, this was done by Morningstar. This is right on morningstar.com. They do a fantastic job. Most well known, I would say, for mutual fund research, a very broad based company, though. They do a lot of research on a lot of different types of investments, and they generally do a very fine job. These examples come from Morningstar's mutual fund research team. And what you can see in this first example where it says research, they looked at a 3-year return of a pharma fund. This would be a pharmaceutical fund, drug companies, drug research, and that type of thing. As of April 22nd, this is a 3-year sample set. As of April 22nd, this particular investment that they were looking at, unnamed, but it was a pharmaceutical fund, it achieved an average annual return of 23%. But you could see what they also found was that the average investor in this particular fund that they researched on Morningstar.com, their actual experience was 6% lower. So the investment return was 23% over that 3-year time frame. And in April of 2022, that was the investment experience. The investor experience was 6% lower. And we could find what happens is, and their suggestion, and we would agree with this, have an investment thesis. When you put money into an investment, it should be, in our opinion, a function of your financial plan. So what is it that you want to achieve? What are the resources you have towards that goal? And what is your time frame? Have that thesis so that you know why you were doing things and how long you have for that to play out. If things happen in between, but your goals have not changed and your time frame has not changed, many times it makes sense to stick with that investment. In the second research that they did, this was over 10 years, what they had discovered in this one particular investment that they had studied was, right here you can find it, that only 6 months of that 10-year time frame contributed to all of the performance. So if you were not in that investment for all of those 6 months, you would not have got the investment return. You would have got the investor return. Because if you were out of this particular investment in this example, for just those 6 months, you would not have gotten the full performance of that investment. So the investment return was pretty solid. The investor return is often very different because in this example, if they missed any of those 6 months in 10 years, just 6 months in 10 years, you would not have got in the investment return. Suggestions here, stop timing your investments. It's easy in theory to say, I'm going to get out when it's going down and I'm going to get in on the way up. That's what we're all trying to achieve. Very, very difficult to do in practice. The basics of investing have not changed. Invest as much as you can, as often as you can, for as long as you can. That has not changed. But what has really changed with technology and with the number of market participants is the inflection points, how quickly these things move. So it becomes harder and harder as time goes on and we get more technology, more market participants. It becomes harder and harder to pick things that are about to go up and get out of things that are about to go down. And so it's very, very difficult to do that. Going back to your goals and your time frames, make sure you understand what your goals are and what your time frames are. Monitor those on a regular basis. Life happens. Also, another idea that they highlight right here is what we call dollar cost averaging. Invest a regular amount for a regular time period, certain dollar amount per month, per quarter, per year, whatever it is. We call this dollar cost averaging. The beauty of this is when the investment is down, let's say you're putting $100 a month into an investment. When the price of that investment is down, you're buying more shares. Kind of like going to the grocery store. If you're going to buy raspberries and the price of raspberries down and you got 10 bucks, you're going to get more raspberries because the price is lower than it was yesterday, for example. However, if you have a bunch of raspberries, you bought an investment once per month. Now you have a bunch of shares. When the price of raspberries goes up, that benefits you. But you keep buying in on a regular basis. It's great to have that discipline. And again, understand what you're able to invest, what your time frame is, how often you're going to invest in your time frame, and how long you want to have that investment. This is one of my favorites right here. This example again from Morningstar Research, best performing equity fund for the 3-year period ended April of 2022. So this was April 19 through April 2022. The best fund that they found in their research achieved a return of 40% over that 3-year time frame. But what's really interesting right here, the average investor in that investment, the investment did 40% over the 3-year time period of April 2019 to April 2022. The investment did 40%, but the average investor only got 20%, half of what the investment did in that time frame. And what they had discovered is about 75% of the inflows into this investment, the investors getting into this investment, 75% of those came in the last year because people look backwards. They say, oh my gosh, this investment has done so great for the last couple of years that I want to get in now. Then they look back 3 years and they say, wait, I only got 20% in this on average, but the investment did 40. Well, why is that? Everybody kind of came to the party late. Remember that past performance is no indication of future return. So the past performance on this investment does not really say much about what it can do in the future. It does indicate consistency, possibly, but it does not say what's going to happen in the next year. So everybody jumps in the last year or 3 years, say, I want to get what the last 2 years did. But they only get a portion of that. So how to kind of avoid that trap, if you will. It's hard to chase performance. Very, very hard to chase performance. Remember, everything that you're reading and all the things that this was a great investment. Talk about what it did in the past. What did you do for me yesterday? Really not going to say what it's going to do for you in the future. So that investment performance does not going to mean you as an investor. That's going to be your performance. Another really important concept, this is in regards to mutual funds, but also indicative of other investments. Nothing does great year in and year out. Nothing is always the best year in and year out. And they, as consumers, that's very similar to a lot of the things that we purchase. You can purchase a consumer item that was the very best thing, the hottest thing flying off the shelves, and then a year that there's something else that comes out. So it's something better, something different. Investments are going to be different. But that really does go back to your plan. What was your goal? What is your time frame? Are you still on the right path? So it's very, very hard to assume that the investment that you have is going to be the very best year in and year out every market cycle. And it also very hard, and it could potentially be damaging if you're jumping out of an investment when it's just because it's down. Again, timeframes haven't changed, goals haven't changed, but yet the investment is down like they have been in 2022. Many investments have been down in 2022. Knee-jerk reaction, jump out of it. I'll wait till it goes back up. Very hard to do, because what would happen is over a specified time period, the investment might do one thing. If you're jumping out and not being able to time that perfectly, which we've already established very hard to time the market, you might not be able to achieve what the investment did as the investor who jumped out. Going back to that earlier example, one fund that they had looked at did pretty well over 10 years, but all of the performance came in 6 months. If you jump out of that and you don't get back in when it's potentially on the upswing, you might miss out on that. So that is the difference between investor return and investment return. Oftentimes, investors experience something different than what the investment is because they emotionally jump in and out. We do our very best to help people avoid similar mistakes. So that is the main difference between what the investment is doing and what you are doing. The big difference is the emotion.